Welcome to the deep dive. Today we're going to dive into Warren Buffett's 2006 letter to Berkshire Hathaway shareholders.
Oh, yeah.
This letter is it's really a goldmine of investing wisdom, and it gives us a glimpse into all these different businesses from insurance and utilities to manufacturing and retail.
And even though it was written almost 20 years ago, the principles and strategies that Buffett outlines are still so relevant today.
Exactly. We're going to unpack some of those key takeaways, explore a few captivating anecdotes, and hopefully uncover some surprises along the way. So to kick things off, Berkshire Hathaway had a phenomenal year in 2006. They achieved a record-breaking $19.9 billion gain in net worth.
Wow.
Yeah, to put that in perspective, that boosted their per-share book value, the net worth of the company divided by the number of shares outstanding, by 18.4%.
That's an incredible return in just 1 year. And it really highlights Buffett's long-term focus. Over his tenure at Berkshire, he managed to grow the per-share book value from just $19 to over $70,000. That kind of consistent long-term growth is what makes him such a legendary investor.
It's amazing. But Buffett, being Buffett, injects a bit of humor into the letter and admits that some of that success was due to Mother Nature taking a vacation.
Yeah, he's referring to the fact that 2006 was a relatively quiet year for major hurricanes. That meant fewer insurance claims, especially in the super cat insurance market, which is the part of the insurance industry that covers catastrophic events.
Super cat insurance. That makes sense.
Yeah.
But it wasn't all just luck, one of Berkshire's subsidiaries. Geico had a truly standout year.
Absolutely. Geico, led by Tony Nicely, saw a 42% increase in policies, while simultaneously reducing their employee count by 3.5%. That translated to a 47% jump in productivity.
Now, for those of you who are not familiar with the insurance world, that kind of efficiency is practically unheard of.
Yeah.
It really speaks to the importance of having a strong management team in place.
It does. Buffett places a huge amount of trust in his managers and gives them a lot of autonomy to run their businesses. He's not a micromanager. He finds great people and lets them do what they do best.
And speaking of Tony Nicely, there's this great anecdote in the letter. One of Berkshire's directors, Don Keough, was so impressed with Geico's performance that he jokingly suggested that shareholders should rename their children Tony.
It's a funny story, but it also reveals something important about Buffett's investment philosophy. He looks for companies with a durable competitive advantage, or what he calls a moat. And a big part of that moat is having exceptional leadership.
So we've got these record profits, and a large part of that is coming from the insurance business. And this brings us to one of the core concepts of Buffett's investment strategy, the magic of insurance float. Can you explain what that means?
Of course, in the simplest terms, float is the money that insurance companies collect in premiums but haven't yet paid out in claims. It's essentially free money that they can invest for profit while they wait to settle claims.
So it's like having a giant pool of money that you can use to generate even more money.
Precisely. And Berkshire's float is massive. It grew from just $17 million in 1967 to a staggering $50.9 billion in 2006.
Wow, that's a lot of free money to work with.
And that's not even the whole story. In 2006, Buffett pulled off a remarkable deal that added another $7 billion to the float. He entered into a huge retroactive reinsurance contract with a company called Equitas.
Okay, now I'm really intrigued. What's the story behind this Equitas deal?
Well, it takes us on a little journey through insurance history all the way back to the 17th century and the iconic Lloyd's of London.
Lloyd's of London, I've heard the name, but I'm not exactly sure what they do.
It's not a typical insurance company. It's more like a marketplace where different groups of investors known as syndicates come together to underwrite insurance policies.
So how does Equitas fit into all of this?
In the 1980s, Lloyd's was hit with a massive wave of asbestos claims stemming from policies written decades earlier. The cost of these claims was astronomical and nearly brought the entire institution to its knees.
That sounds catastrophic.
So to try and resolve the crisis, they created Equitas in 1996. Equitas was essentially a separate company that took on all of Lloyd's liabilities from policies written before 1993.
That's where Buffett saw an opportunity.
Exactly. He saw a chance to deploy Berkshire's capital in a way that most others wouldn't even consider. Buffett agreed to pay all of Equitas's future claims up to $13.9 billion in exchange for $7.12 billion in cash and securities.
So he was basically taking on a huge amount of risk.
He was, but it was a calculated risk. Buffett knew that asbestos litigation was complex and drawn out. He believed that by taking on this risk, he could not only add significantly to Berkshire's float, but also potentially earn a profit if the ultimate claims turned out to be less than what he paid for them.
It's a bold move, but that seems to be a recurring theme with Buffett. He's not afraid to make big bets when he sees an opportunity that others are overlooking.
That's a great observation.
Right.
And it's a key part of what makes him such a successful investor. He's patient, he's disciplined, and he's not afraid to go against the crowd.
So we've seen how the insurance business played a huge role in Berkshire's success in 2006. But what about the rest of their portfolio?
Well, in addition to insurance, Berkshire also owns a diverse collection of non-insurance businesses, ranging from See's Candies to Fruit of the Loom. These businesses earned an impressive 25% return on tangible net worth in 2006.
Any standout examples from this part of the letter?
One that really caught my eye was the acquisition of Icecar, an Israeli cutting tool company. It's a fantastic example of how Buffett identifies exceptional businesses with strong management teams and a durable competitive advantage.
Tell me more about Icecar. How did that deal come together?
It all started with a simple letter the chairman of Icecar wrote to Buffett expressing his admiration for Berkshire and proposing a partnership. They believed that joining the Berkshire family would allow Icecar to continue thriving while maintaining its unique culture and values.
So it wasn't a hostile takeover or a bidding war. It was more of a mutual admiration society.
Exactly. Buffett is not interested in acquiring companies that don't want to be acquired. He wants to partner with businesses and management teams that share his long-term vision and values.
I love how personal that is. It's not just about the numbers, it's about finding the right fit.
It is, and after receiving that letter, Buffett was intrigued enough to invite the Icecar team to Omaha to learn more about their business. He was impressed with their management, their commitment to quality, and their overall approach, and true to form. Buffett didn't just rely on presentations and spreadsheets. He traveled to Israel to see their operations firsthand.
He wanted to get a feel for the company culture, meet the people, and really understand the business from the inside out.
He did, and what he found was a company with a strong culture of innovation, a commitment to its employees, and a dedication to its customers. It was a perfect fit for Berkshire.
It's fascinating how some of these deals come together. Okay, so we've got record profits, the magic of insurance float, and this intriguing Icecar acquisition. What else stands out to you from this part of the letter?
Well, it's worth noting the contrast Buffett draws between these success stories like Icecar and the challenges faced by another industry newspapers. He specifically mentions the declining fortunes of the Buffalo News, a newspaper that Berkshire owns.
This was already happening back in 2006.
Yes, the writing was on the wall. Buffett acknowledged the disruptive power of the internet and how it was fundamentally changing the media landscape. Newspapers which once enjoyed a monopoly in local markets were losing readers and advertisers to online platforms.
It's incredible how he saw this shift happening so early on. So many others in the industry failed to adapt.
He even points out how many intelligent newspaper executives were either blind or indifferent to the changes happening right in front of them. They continued to operate as if nothing was changing, and as a result, many newspapers struggled to survive.
It's a cautionary tale, isn't it? Even the smartest people can miss major shifts if they're too attached to the status quo.
It is, and it's a reminder that we all need to be willing to adapt and evolve as the world around us changes.
Okay, so we've covered a lot of ground already. Berkshire's record performance, the magic of insurance, float, the fascinating Icecar acquisition, and the challenges facing the newspaper industry. Where do we go from here?
Well, in the next part of our deep dive, we'll explore Buffett's broader market observations and investment philosophy. He had some interesting things to say about the U.S. trade deficit, the rise of derivatives, and the search for his successor.
All right, we're back and ready to delve a little deeper into Buffett's 2006 letter to shareholders.
Okay.
So far, we've covered, Berkshire's outstanding performance and kind of gotten a glimpse into his investment strategies. But now let's zoom out a bit and explore some of his broader economic observations.
Yeah, this is where we see Buffett, the astute observer of global trends, sharing his thoughts on things like the U.S. trade deficit and the rise of derivatives.
Right, and this is where it gets really interesting for me because he starts talking about pseudo-trade and how it was impacting the U.S. economy back in 2006.
Right.
Can you break that down for us?
Sure. In simple terms, Buffett was highlighting how the U.S. was importing a massive amount of goods and services without a corresponding level of exports. He pointed out that the U.S. imported $760 billion more than it exported that year. Essentially, we were consuming more than we were producing, financing that gap by selling off assets or taking on debt.
So it's like a family that keeps racking up credit card debt to maintain their lifestyle.
Exactly. And Buffett used that analogy in the letter. He likened the U.S. to a very wealthy but self-indulgent family living beyond its means.
And he warned that this kind of behavior couldn't go on forever.
Yeah, he pointed out that for the first time since 1915, the U.S. had a negative investment income balance in 2006. What that means is that foreigners were earning more from their investments in the U.S. than Americans were earning from their investments abroad.
So we were essentially sending more money out of the country than we were bringing in.
Precisely, and Buffett cautioned that this trend could have serious consequences down the road. He predicted that at some point, U.S. workers would have to work part of each day just to pay for the overconsumption of previous generations.
That's a pretty sobering thought.
It is, but it also highlights Buffett's long-term thinking. He's not just focused on the next quarter or the next year. He's thinking about the long-term health and sustainability of the U.S. economy.
Now let's shift gears a bit and talk about derivatives.
Yeah.
This is where Buffett gets into some pretty complex financial instruments.
It is, and derivatives have a reputation for being risky and opaque, but Buffett, despite his well-known skepticism of these instruments, reveals in his letter that Berkshire actually had a small portfolio of derivative contracts.
Wait a minute, didn't he have a bad experience with derivatives at Gen Re?
He did, and he's been very vocal about the dangers of derivatives, especially when they're not properly understood or managed. But he also recognizes that, like any financial tool, derivatives can be used responsibly and can sometimes present unique opportunities.
So it's not a black and white issue for him.
Right. In the letter, he explains that Berkshire had 62 derivative contracts outstanding at the time, which he personally managed. He emphasizes that these contracts were carefully selected and structured to minimize risk. He even goes so far as to say that they were free of counterparty credit risk, meaning Berkshire wouldn't lose money even if the other party in the contract defaulted.
So he was being very selective and strategic in his use of derivatives. It wasn't just reckless speculation.
Exactly, and I think this highlights a really important lesson for all investors. Don't let fear or dogma prevent you from exploring different investment strategies. The key is to do your homework, understand the risks involved, and only invest in what you truly understand.
Okay, that makes sense. Now, towards the end of the letter, Buffett starts to address the question of succession. He mentions that Berkshire had 3 outstanding candidates who could potentially replace him as CEO. But finding a successor for the investment side of the business was proving to be more challenging.
That's an interesting point. He's essentially acknowledging that finding someone who can replicate his unique investment approach and manage such a vast portfolio is no easy feat.
And he outlines some very specific qualities he's looking for in a potential successor. It goes beyond just having a good track record or being a brilliant analyst.
Absolutely. He's looking for someone with the right temperament, someone who is genetically programmed to recognize and avoid serious risks. He emphasizes the need for emotional stability, independent thinking, a deep understanding of human behavior, and a genuine passion for the game.
He wants someone who can stay calm under pressure, think for themselves, and not get swept up in the hype or the herd mentality.
Exactly. And to illustrate this point, he tells a story about Walter Schloss, a highly successful investor who achieved incredible returns using a simple value-based approach that he learned from Ben Graham.
This Walter Schloss story is fascinating to me because it kind of debunks the myth that you need to be a Wall Street insider or have some super secret formula to be a successful investor.
It does. Walter Schloss demonstrated that you don't need complex algorithms or fancy trading strategies. You can achieve exceptional results with discipline, patience, and a focus on fundamental value.
And I think this story is particularly relevant today when we're bombarded with so much information and so many different investment strategies. It's easy to get caught up in the noise and lose sight of the basics.
It is, and that's why Buffett's emphasis on temperament and independent thinking is so crucial. You need to be able to block out the noise, think for yourself, and stick to your principles, even when the market is going crazy.
It's a great reminder that sometimes the simplest approach can be the most effective.
Absolutely, and I think it's a testament to Buffett's humility that he's so willing to highlight the success of others, even when it might seem to contradict his own approach.
Yeah.
He's not afraid to admit that there are many different paths to success in investing.
So we've covered a lot of ground in this part of the letter, from the U.S. trade deficit to derivatives to the search for a successor. It's amazing how much insight and wisdom is packed into these pages. What's next on our deep dive?
Well, in the final part, we'll explore Buffett's philanthropic vision, his thoughts on corporate compensation practices, and his enduring belief in the power of long-term investing.
We're back for the final part of our deep dive into Warren Buffett's 2006 letter to Berkshire Hathaway shareholders. We've covered a lot of ground, from record profits to the magic of insurance, float to his thoughts on the broader economy.
Yeah.
But there's one area we haven't touched on yet. Buffett's remarkable commitment to philanthropy.
Yeah, it's a fascinating aspect of his legacy. In this letter, he details his plans to gradually give away the vast majority of his wealth to charitable foundations. What really struck me was his insistence that the funds be distributed and put to work relatively quickly rather than sitting in endowments for generations to come.
That's right. He believed that the people closest to the problems were often the best equipped to allocate resources effectively.
Right.
He didn't want decisions about how his wealth was used to be dictated by a will written years in advance. He trusted those on the ground to identify and address the most pressing needs.
And he wasn't a big fan of the idea of perpetual foundations, the kind that are designed to exist forever.
Right.
He argued that while there will always be important societal issues, future generations would also have their own wealthy individuals and families who could contribute to those causes.
It's an interesting perspective. He saw philanthropy as a dynamic and evolving ecosystem with new actors and solutions constantly emerging. He didn't believe in locking up wealth in perpetuity.
Precisely, and he addressed concerns that some shareholders had about the impact of foundation sales of Berkshire stock on the market. He assured them that these sales wouldn't crash the market, pointing out that even with additional sales by the foundations, Berkshire's trading volume would still be relatively low compared to other stocks.
He was always thinking ahead, anticipating potential problems and addressing them head on.
Yeah.
And I think this speaks to his commitment to transparency and fairness. He wanted to ensure that incoming shareholders weren't overpaying for the stock, even as the foundations were selling.
It's clear that he was deeply committed to acting ethically and responsibly, not just in his business dealings, but also in his philanthropic endeavors.
Now, shifting gears a bit, Buffett also took aim at what he saw as excessive fees and misleading practices on Wall Street. He used this clever analogy of the Gottschalk family to illustrate his point.
Ah, yes, the Gottschalk family. They represented, in a way, all of America's investors, and Buffett argued that many of these investors were being misled by unrealistic expectations of returns and were paying exorbitant fees to financial advisors and fund managers who were essentially promising them the impossible.
He was particularly critical of the 2 and 20 compensation structure common in hedge funds, where managers take a 2% annual fee and 20% of any profits. He saw it as a system that enriched the managers at the expense of their clients.
Yeah, and he pointed out that even if a fund manager generated a decent return, a large chunk of it would be eaten up by fees, leaving investors with less than they could have earned from a simple index fund.
It's a powerful critique of the Wall Street fee machine. But then to contrast that, he tells this amazing story about Walter Schloss, his friend, and an incredibly successful investor who achieved fantastic returns without all the fancy fees or complicated strategies.
It's a brilliant juxtaposition he's showing us, that you don't need to be a Wall Street insider or a financial wizard to succeed in investing. Walter Schloss proved that a simple value-oriented approach coupled with discipline and patience could produce outstanding results.
And I love how Buffett contrasts Walter's success with the then popular efficient market theory that was being taught in business schools. This theory basically argued that it was impossible to consistently beat the market because all publicly available information was already reflected in stock prices.
Buffett saw Walter Schloss as living proof that this theory was flawed. He demonstrated that skilled investors could, in fact, identify undervalued stocks and outperform the market over the long term.
So as we wrap up our deep dive into Buffett's 2006 letter, what are some of the key takeaways for you? What should listeners be thinking about as they reflect on his words?
Well, for me, one of the biggest takeaways is the importance of aligning your investments with your values. Buffett's commitment to philanthropy is a powerful example of how wealth can be used to make a positive impact on the world.
I agree, and it's not just about giving money away. It's about thinking strategically about how those resources can be used most effectively to create lasting change.
Another important lesson is to be wary of anyone who promises easy money or outsized returns. As Buffett illustrated with the Gottschalk family analogy and his critique of the 2 and 20 fee structure, there are plenty of people in the financial industry who are more interested in enriching themselves than in helping their clients.
It's a reminder to do your homework, ask tough questions, and not be afraid to walk away from investments that seem too good to be true. Trust your gut, and don't let anyone pressure you into something that doesn't feel right.
And finally, I think Buffett's story about Walter Schloss reinforces a timeless lesson for investors of all levels. Focus on finding undervalued businesses. Be patient, and don't get caught up in the hype or the latest fads.
It's a strategy that has worked for decades, and it's likely to continue working for decades to come. Stick to the fundamentals and don't try to outsmart the market.
That's great advice, and this 2006 letter is a treasure trove of wisdom and insights. It's amazing how relevant it still is, even after all these years.
It is. It's a reminder that even though markets change and industries evolve, the principles of sound investing and ethical business practices remain timeless.
And if you're looking for a shortcut to becoming a more informed and insightful investor, you can't go wrong by spending some time with Buffett's wisdom. His letters are available online for free, and they're well worth the read.
Absolutely. Thanks for joining us on this deep dive. We'll be back soon with another fascinating exploration of knowledge. Until then, keep learning, keep questioning, and keep diving deep.